Hello and welcome to another quick guide. In this video I'm going to be looking at the accounting entries used to write off bad or irrecoverable debts. So let's look at this example. Fred started trading as a sole trader on the 1st of January of year 1. Fred sells widgets. In June of year 1, Fred sold £500 of widgets on credit to John. And here is the sales account. There are some sales here, 12,500, which had been sold before the 500 which was sold to John, and there is the £500 of sales sold to John. And immediately upon entering these sales, the sales also become a receivable. So let's have a look at the receivables control account. And here we can see John's £500 was put into the accounts receivable control account. Of course you wouldn't see John, you just see the total sales figure, but obviously for this example we can see the £500 from John. Or rather, we can see the £500 that is receivable from John. And if we go back to the example, we can see that on the 31st of October of year 1, John hadn't paid that £500. And so Fred decides to write off the debt on this date, the 31st of October. And to do this, there are two accounts involved. There is the bad debt expense account, which is also known as the irrecoverable debt expense account, and then there is the accounts receivable or receivables control account, as well as John's individual account in the sales ledger. So as always, when writing a journal, we start with the debit entry first, and so we need to debit the expense account, the bad debt expense account, with the £500. And so here we can see the bad debt expense or the irrecoverable debt expense account, and what we need to do is to put in John's £500 of bad debt that Fred has decided to write off. And so there we can see that in October of year 1, the cross-reference is the other account, which is the accounts receivable. A reference for this example is John, and the value is £500. And that deals with the debit entry for this transaction. The credit entry is to remove the debt from the accounts receivable control account, as well as John's individual personal customer account. And so this is the accounts receivable control account, and here we can see that there were some sales beforehand, and here we can see that John is a receivable of £500. Well, we're about to remove that, and we remove that by putting in a credit entry. And there is the credit entry. It's in October. It's the cross-reference. The other account is the bad debt expense or irrecoverable debt expense account, and for our reference we've put in the word John, and we can see that it's £500. And what this £500 credit into this accounts receivable control account has served to do is to reduce the value of the accounts receivable by £500. We need to make a note in the customer's individual account that the debt has been written off so that we can keep a record of it. And here we have the customer account John in the sales ledger, and here we can see £500 bad debt written off, and presumably and naturally the account is now closed. And those are the two entries required to write off a bad debt completely. We increase the bad debt expense account by entering a debit value, and we remove the debt from the accounts receivable control account by entering a credit value, and naturally we close the customer's individual ledger account. If during this period there are absolutely no other bad debts written off, then at the end of year 1, when the financial accounts are being prepared, then the £500 written off from John will show as an expense in the statement of profit or loss. So far we've seen that Fred has written off the £500 debt from John, and we also presumed that perhaps during the whole of year 1 Fred didn't have any further bad debts, and at the end of the financial year the bad debt expense would be £500. But what now happens if, for some unknown reason, John pays the full £500 of his debt to Fred on the 1st of December? Remember, on the end of October, Fred wrote the debt off, but in December, on the 1st of December, for some unknown reason, John pays Fred the full £500. What are the accounting entries for that? Well, there are two methods to deal with the accounting entries for scenario 1. But let's start with receiving the money. Of course, the first accounting entry is to debit the bank for the money received of £500. But where are we going to put the second entry, the other side of the double entry? This is where there are two methods, and I'll show both methods here. Method 1 is the simplest and I think probably the best. And so, as I just said, we will debit the bank with £500, and with method 1 we simply go over to the bad debt account and we credit bad debts with £500. And so here we can see the credit entry in December from the bank with our reference John, and the value is £500. That now brings the bad debt expense account balance to 0, and if Fred by the 31st of December doesn't have any other further bad debt to enter into the bad debt expense account, then the balance of the account is going to be 0, nothing to report in the statement of profit or loss. And that is method 1. So now I'll show method 2. So with method 2 it involves the accounts receivable control account, and then it involves reversing the entry in the bad debt expense account. So here we are at bank, £500 received, so the other entry in this example is going to be accounts receivable control, and this is the accounts receivable control account before we've done the other entry from the bank account. And there it is, December, the cross reference is the bank account and our reference is John, but we can't leave it like that because what we've done in October is reduce the accounts receivable balance by 500, and if we just left it as it is now, we've further reduced the accounts receivable control account by another 500. So this method, method 2, is to reinstate the debt, and we do that by debiting the accounts receivable with £500, and the other entry is to credit the bad debt expense account with £500. And this is the bad debt expense control account, and I'm just going to put the cross-reference, the other entry, accounts receivable control, £500. Method 2 seems to be somewhat long-winded because you get the same result. So in method 2 it's debit bank, credit accounts receivable control. You then debit accounts receivable control to reinstate the debt, and you credit bad debts. Now that's exactly the same as debiting bank and crediting bad debts and cutting out the accounts receivable completely, because it only cancels each other out anyway. That's an interesting one to note. Now, if Fred has no other bad debt expense to the 31st of December of year 1, then there will be nothing to report for a bad debt expense on the statement of profit and loss because it's cancelled itself out. The bad debt expense has a debit of 500, now it has a credit of 500, the net balance is 0. So let's take a look at another scenario, scenario number 2, and in this scenario John pays £400 out of his £500 debt on the 1st of December of year 1. The first entry will be the debit to the bank to receive the £400, and using method 1 we're going to go directly from bank straight into bad debt expense and put the credit of the £400 into there. And let's assume that Fred has no further bad debts for all of December for the rest of the financial year for year 1. So what we're going to do now is balance the bad debt expense account. Here we can see that the debits are 500, which is the larger of the two figures, and so the credit here is 500, and to balance the account we need to have a balancing figure here, which is obviously 100. So we can see that the end of year 1 the balancing figure is 100, therefore the balance brought down at the end of year 1 is £100. Now this needs to be transferred to the statement of profit or loss, or the profit and loss account, and the way we do that is by putting the £100 credit and sending that £100 to the profit and loss, in this case profit and loss statement. We've now balanced the account, and the double lines underneath indicate that the balance is 0, no balance to bring down. And in this case, because we've just carried out one half of the double entry, we need to put the bad debt written off of £100 expense into the statement of profit or loss as we continue to build it. And this is the sales account. I'm just going to imagine that after the original sale to John, that Fred made further sales of 13,500, and this gives a total of 26,500 there and 26,500 there, and the balancing figure is 26,500, which gives a brought down balance of 26,500, and this 26,500 is transferred to the profit and loss, and here we can see it in the row for sales. And so we can see that because John paid £400 out of the £500, there was still £100 bad debt expense, which now has been transferred into the statement of profit or loss at the end of year 1. Okay, let's take a look at the third scenario, which is that John doesn't pay off any of the debt by the end of Fred's year-end year 1. So if we go back to October of year 1, we can see here that the original £500, Fred wrote that off as an irrecoverable debt in October, and so now it's come to the 31st of December of year 1, we need to balance the bad debt expense account. So we've got 500 here and we've got 500 here. We need a balancing figure. Well, that's 500, and so we need to bring down a balance because we've just made a balance. So there's the brought down figure, and that brought down figure is going to be transferred over to the profit and loss. And here's the profit and loss, and the expense for bad debts is the full £500 that John didn't pay to Fred. And notice that there is no balance to bring down. The two double lines indicate the balance is now 0. The bad debt expense has been transferred or emptied into the profit and loss for the end of year 1. And at the end of year 1, this is an extract from the profit and loss statement. We can see the sales at 26,500 and the bad debts written off in the list of expenses is £500. So now we're into the second financial year of Fred's sole trader business, and what happens in scenario 4 in year 2 is that John, who owed the £500, pays £250, but this time he pays it in the second financial year, in February of year 2. So how are we going to deal with that? Well, the first thing we need to do is to receive it into the bank, and so there we can see the debit into the bank for £250, and the cross-reference is the bad debt account, and we're going to put £250 into the bad debt account right now. And so we can see that at the end of year 1 the bad debt expense account was emptied into the profit and loss, and so there is no balance to bring down. However, we've just received £250 into the bank, and we need to put that against the as a credit, in fact, to the bad debt expense account. And here it is, we've received the 250 into the bank, and we've put it into the correct other double entry account bad debt expense. And the scenario tells us that Fred has another bad debt during the year, £250 from Sarah, and so he needs to write this off also. And so he'll do it in the usual way by debiting bad debt and crediting accounts receivable. So here we can see that we've entered the £250 from Sarah, the bad debt from Sarah, into the bad debt expense account, and now we need to go to the accounts receivable and reduce the receivable balance by £250. So before I put in the other entry for Sarah, I just want to point out year 2 the balance brought down was 26,000. I've just imagined that customers have paid 24,000 of that 26,000, and so far before Sarah's bad debt Fred had sales of £3,250 on credit. I'm now going to put Sarah's entry in there to reduce the value of the accounts receivable and to finish the second entry of the double entry. And so there it is, we can see that Sarah's bad debt has been entered into the accounts receivable control account. And so looking at the sales account, I just made up a figure. I imagined that Fred made sales of £3,250 on credit before Sarah's bad debt. And now let's just imagine that it's come to year end and there are no further bad debts. So we're coming to the end of year 2, and let's just imagine a figure that Fred made in sales for the remainder of year 2. And I've just imagined that Fred has made sales of £28,000 for the remainder of year 2. And so I'm going to put that £28,000 as a receivable for the remainder of year 2. And there we can see the £28,000. And so what happens to the profit and loss statement for year 2? Well, let's strike a balance on the sales account. And here we can see that at the end of year 2 we've taken a balance, and the balance brought down was 31,250 for sales. This is the sales account, and so to the profit and loss we transfer 31,250, and there we can see the 31,250 has been transferred from the sales account into the statement of profit or loss. And now we need to look at what, if any, balance should be into the expense bad debt written off expense account. Well, if we take a look at the bad debt expense account, you can see that there's a debit there from Sarah of 250, but there's a credit there from John of 250. So if you took a balance there is no balance to transfer to the statement of profit or loss because the balance is zero. They cancel each other out. There is nothing to report. And so the bad debts expense wouldn't even appear in the statement of profit and loss, but if it did, there would be a zero, nothing, nil. And those were the entries for scenario number 4. Okay, and this is scenario 5, and in scenario 5 John pays £250 of his £500 original debt in February of Fred's second financial year, year 2, and we're going to assume for this scenario that Fred has absolutely no other bad debts in year 2. And so in the bank account we're going to receive the £250 from John, and we're going to use method 1 where we are going to credit the bad debt expense account. And here is the bad debt expense account. Looking at it, you can see that it was closed off at the end of last financial year, and so there's no balance to bring down, and you can see that there's no balance brought down because it's been emptied into the profit and loss statement. But we've got to do the other side of the double entry for the receipt from John, and there it is, a credit of £250. And that credit entry completed the double entry for the receipt of £250 from John. Remember, the scenario said that Fred has no other bad debts in year 2, so now let's fast forward the end of financial year 2 and see what the statement of profit and loss looks like. Well, we can see that the sales figure is going to be 31,250 as in scenario 4, and we can see that there in the statement of profit and loss we have 31,250 in the sales figure. But this time we've got a credit balance on an expense account, which is normally a debit balance. So what are we going to do with that? Well, we're still going to empty or transfer the balance, the £250, over to the profit and loss statement, but instead of putting a credit into an expense account, which would be silly, we're going to put the £250 and other income of bad debt recovered. And this would give a total income of 31,500. And that's how to put the accounting entries in for scenario 5. Thanks for watching.